This is the Ozone Radio Show, where we bring you facts, not fiction, by focusing on timely information you can share with confidence, because we value realism, not sensationalism or shock value. So join us now for ideas and information you can use right away.
Hi, everyone. I'm Bill Storie, and I welcome you to the Olderhood podcast. And my guest today is Nick Rilley, who is a Senior Investment Manager and Strategy Analyst at Butterfield. Hi, Nick.
Hello, Bill.
Let's move on to fixed income. What has been the impact? Again, we go back to the issues that we've been talking about, the Russia-Ukraine situation, perhaps inflation, whatever sort of thing. But how much have those world events affected the bond markets? Let's look at that first.
So yeah, just going back to the beginning of the year, as I said, the theme was inflation, and we know that inflation is bad for bonds generally because they're kind of paying a nominal income, and inflation is eating away at that nominal income. So, as I said earlier, the central banks globally have been reacting to these inflationary pressures by putting up interest rates. So higher interest rates are obviously bad for bonds, so yields up, prices down. So the bond market was in a difficult position prior to Russia-Ukraine. So then when Russia-Ukraine really came onto the radar, it was sort of the 24th of Feb when the invasion happened. So initially, people looked for safe assets. And what's been a safe asset over the last, many decades really has been US Treasuries. So the dollar has been quite defensive as a currency, and Treasuries are a very safe asset within the US. So something bad happens in the world, the knee-jerk reaction is for investors to buy treasuries. And that's actually what happened in that third week of February earlier this year. But then what happened is kind of people stepped back and assessed, the real nature of what was happening. If you look back through history, wars are very inflationary periods. And it's kind of obvious why, because in a war, productive capacity gets destroyed. So you think, the energy that's coming out of Russia potentially, and sanctions that may or may not be imposed there. The planting season in Ukraine for agricultural goods is in jeopardy. So wars are inflationary. So people stepped back and thought, okay, the problem was inflation initially, and we're going to get more inflation. Therefore, central banks are going to have to do more than they were planning on doing previously. So the bond market's had a really, really tough time this year, and especially in March. So yields have been moving up substantially. So at the beginning of the year, the market was looking for maybe 3 interest rate rises in the US this year. Now that's more like 9 or 10. So we've had a huge shift in interest rate expectations. So it's been a very negative period for bonds. So in the US, the aggregate bond index was down about 6%, and that's the worst return from bonds since 1980. So for what is supposed to be a safe investment, it's been a really tough, challenging period. But the flip side is there's now more value in bonds. So yields are higher, you get compensated more income for holding bonds than you did.
Help me understand one thing. You talked about the Fed, which is a US Federal Reserve, that they've been active. How does an interest rate change within the Fed, within the United States, how does that actually impact world or global bond markets? I mean, does that, as it were, automatically impact the European markets, the Asian markets? Who's the big guy? Who's the big guy in the block?
You ask a very complex, difficult question. I wish I had a good answer. It's something that the Fed themselves struggle with this, and it's something that has two-way causality. So if you go back to when Ben Bernanke was in charge of the Fed, he, in the 2000s, he wrote a lot about kind of savings gluts. So countries that were oil exporters or big exporters in general in Asia, they would accumulate these big surpluses, and then they would invest those surpluses in the US Treasury market. So the kind of perceived wisdom at that point was that overseas investors were putting downward pressure on bond yields in the US, interest rates in the US. And so that was kind of a challenge. So the Fed was putting up interest rates, but not all interest rates were going up because the rest of the world was buying US dollar bonds. So that was kind of one school of thought. The other school of thought, dollar is still the main reserve currency in the world. A lot of people hold dollar assets. A lot of central banks hold dollar assets as part of their reserve portfolios. It's still the largest reserve asset by a significant margin. So when the cost of that reserve currency goes up in terms of interest rates, that has a bad knock-on impact for the rest of the world. So anyone who is exposed to higher interest rates in dollars and has their assets in a different currency, so like emerging markets, for example, they tend to have dollar liabilities and local currency assets. So you get these mismatches in terms of assets and liabilities. So it's kind of like, well, when the US puts up rates, it causes a problem for the rest of the world. So we're seeing that now with some of the emerging markets, but it's really a question of, where are these weak points in the world when US rates go up? And Europe is a very difficult, region to assess, because the link between Europe and the US is very difficult to ascertain.
Yeah, we've only got a few minutes left, so I hate to put you on the spot regarding global equities, but obviously the equity markets have been impacted again by the same issues that we've been talking about. We've seen some wild swings, I think, obviously in the political, the economic events, etc. I mean, overall, from the equity market, how badly or perhaps not have they been impacted by those events?
The market's actually been rather resilient. So markets in Q1, I think they were intra-quarter drawdown was something like 13%. So we had some quite sharp sell-offs, particularly in places like Germany, where the country is more exposed to Russia-Ukraine situation. But then we've seen some pretty strong bounce backs in a lot of markets. So that's been pleasing. So part of the reason for that is that commodity prices haven't gone up quite as much as people were worried that they might. So we had people talking about oil at $150 if the EU sanctioned Russian energy. So far they have not. So oil is, it's closer to 100 than 150. But now we've got people talking about oil potentially being, $185 if they sanction Russian energy exports. So the commodity situation is not good, but it's not as bad as feared. So that's been part of it. And corporate earnings have continued to be pretty strong as well, albeit less strong compared to last year. But there's been a lot going on under the surface. So things like energy and materials have been doing well, whereas some of the consumer-orientated stocks, so things like consumer discretionary, Netflix is a good example, which is not technically a consumer discretionary stock, but essentially it is. And they've lost subscribers in Q1 for the first time in 10 years. So there's some challenges as to consumers getting squeezed by inflation and then deciding what they're going to be spending their money on. So discretionary purchases are under more stress compared to something like consumer staples, where people will buy food because they need to, whereas you don't need discretionary goods. They're nice to have items generally.
And I think one factor to take into account really is that, we always talked about the US economy being an advanced economy, whether that was technology or whatever it may be, to a lesser extent, perhaps some of the European countries, to an even lesser extent, some of the Asian countries. But, most of those countries have now caught up. They may not still be as technologically in tune with or compared to the US, but so the world demand for products, which, 30, 40, 50, 60 years ago was very fragmented, I think, it's not fragmented anymore. Some of these countries are really advanced countries because they picked up on the technological blip. They didn't have to go through the trials and tribulations. They just jumped straight on to being, pretty accurate sort of thing, But anyway, listen, I know we could talk for ages about some of these things and get a little bit deeper into equities, but we're frankly now running out of time, Mr. Rilley. So my guest today has been Nick Rilley, Senior Investment Manager and Strategy Analyst at Butterfield. And this is Bill Storie signing off on the Olderhood podcast, and we'll catch you again next time. Take care, everyone. Bye.